Welcome back to the More Than Money podcast. Casey, today I wanted to ask you about something we really get a ton of questions about from people working at corporations. The difference between a Roth and a regular 401k. More and more companies these days are offering employees the choice between these two types of accounts. And it really seems that people aren't clear about how they should make the choice of which one to contribute to. And I'll tell you what I see most of the time, they'll do like half and half just because they're not exactly, sure which one is better. So they'll like do 50% of contribution one, 50% of contribution on the other one. So I would love to have that conversation today.
I agree. That's probably one of the most common questions I get from people. It's really on their minds. They are curious what the difference is between the two different types of accounts. And they're usually relieved to hear that the way they should choose between a Roth and a regular 401k boils down to one simple question.
All right, that's good.
Yes, except that one simple question is completely impossible to know the answer to.
Okay, well, what is it? I mean, it's one of those like, tell us, please. How can we crack the code?
The question is, will my tax rate be higher or lower in retirement than it is now? Which,
of course, really no one can know the answer. I mean, I get it, right?
Yeah. So let's back up for a quick second and talk about how Roth and regular 401ks are similar, and then let's talk about how they're different.
Okay. They're much more similar than they're different, correct?
Yes. And we talked about 401ks last week, as I'm sure you remember.
I mean, I have my notes from just last week. Obviously, the stuff that we covered were they're automatic savings, they're automatically invested, they're locked up, they're tax advantaged. They encourage you to save sooner in your career as soon as you have a job that hopefully offers it. Flexible, so you can go up and down, do more, do less. The one that's funny, the bankruptcy protection, obviously, that's hopefully nobody has to worry about that. And of course, if you're lucky enough to work at a company that has the match, so that's just the free money, right?
Yes. So of course, those are all true. Those are all true of both Roth and regular 401ks. And the only difference is
the Roth is after tax money and the regular is before tax money. We talked about that.
Exactly. So with the regular 401k, you're putting 100% of your earned salary in. And with a Roth, you're putting in your earned salary minus what you paid in income taxes. So then with a Roth, all the money you have in your account is yours to keep because you've already paid taxes on it. And with a regular, you still owe income taxes on that money.
All right, so that's an interesting thing about Roths versus regulars, right? If you have 100K in a Roth 401k, you have 100K. If you have 100K in a regular 401k, you don't know really. You have to minus the taxes you still need to pay. Not all of that balance is really yours. So it can be 60 or 70, depending on what the government says, and then depending on your personal, deductions and life and stuff. So that's something that people should be aware of, obviously, when they're planning their retirement.
Yes, exactly. And the other thing actually I think is interesting is that if every single thing remains the same, meaning two people put the exact same amount in, they have the exact same return, the exact same time period, they have the same tax rate, everything. If everything is the same, they will have the exact same amount of money to the penny as each other. So the only variable is whether or not their tax rate will be higher or lower when they take the money out of that account in retirement.
All right. So if they expect to be in a higher tax bracket in retirement, they'd want to pay taxes now and I always talk about it from, do you want to pay the taxes on a seed or the harvest, right? Because it's more money because of, compound environment. It's going to grow and grow and grow. They want to pay taxes now up front. So they want to choose the Roth. But if they expect to be in a lower tax bracket in retirement, they'd want to kick the can down the road, obviously, and pay their taxes later on. So they would want to choose a regular 401k in that situation. Is that right?
Yeah, exactly. That's the one simple question they can't possibly know the answer to. Tax rate higher or lower in retirement?
Well, so this is the thing, I love history and I love teaching all this stuff, right? But historically, we are probably second or third lowest tax bracket in the United States history. The average is, almost 60. The highest tax bracket, which most people don't know, is, was 94 back in 1942. So it is crazy where taxes have been and where they can be. So really understanding, probability, it's something that people should learn where taxes can go and understand that. So before we go, how do people make that decision?
Well, some people don't, like you were saying in the beginning. Some contribute to both the Roth and the regular to hedge their bets. So in this upcoming year, 2021, you can put up to $19,500 into both accounts if you're below 50, and there's catch-up contributions above 50. I think there's $6,500 next year.
Yep.
So you could put 19 and let's just say you're below 50, which we both are.
I am.
So far. So let's say you put you can put $19,500 into both accounts. So that's a total for the year. So some people, like you were saying in the beginning, split their contribution down the middle because they don't know what to do and they want to hedge their bets. Other people don't have the opportunity to make that decision because their employer only offers one or the other type of account for them to contribute to. So there's no decision to be made there. Other people actually have have an idea of where they might retire, and they have some information currently on whether it's a high or a low or a no income tax state. So if you know you live in a really high income tax state now, and you expect to retire to a no income tax state or vice versa, you can take that into consideration. And of course, it sounds like maybe you have an opinion. If you have an opinion on where you think overall taxes will go over the next few decades, you should definitely be considering that as well.
I mean, it's a great point. I mean, you just saw Elon Musk move to Texas from California, and he's saving 13% of income tax on all of that stuff. So great info as always. Simple question. Nobody knows the answer to, so totally worthless podcast, but I like it. It's great. Thanks so much, Casey. Thanks for tuning in to another episode of the More Than Money podcast. If you feel like you learned something or enjoyed this episode today, we ask you to do a few things. Number one, leave us a 5-star rating and a review on whatever platform you're listening to. If there's something you're struggling with and want us to cover, let us know in your review and we'll make sure to cover it soon. Second, make sure to follow Sqwire on social media and share this podcast with any workers, employees, or friends. This podcast is made possible by Sqwire, customized financial wellness program that will help you create a culture of care with happier and healthier employees day in and out. Whether you're a business owner, HR manager, or just someone trying to live your best life, Sqwire is for you. Head over to Sqwire.com to learn more about how Sqwire can transform your workforce. And that's SQWIRE.com.